Hello, and thank you everybody for joining. It's a pleasure for me to chair this webinar today. My name is Lorenzo Moretti. I'm a research fellow at the Florence School of Banking and Finance, where I coordinate our initiatives on equity investing, venture capital, digital finance, and innovation. Today we are here to talk about a specific issue, but that has implication for a broader and I would say very topical question, which is to what extent Europe's proactive approach to regulation actually helps the industry targets, or instead it risks adding more compliance, but with little practical impact. So we will get into that. Before that, for those who don't know us, I want to introduce very briefly the UI Florence School of Banking and Finance. So we were established in 2016, but with a much older and broader institution, the European University Institute. The European University Institute is a real, let's say, transnational hub for research and higher education. It's a research-focused university dedicated to the social sciences. But we're also an international organization, so we have member states. Most of the EU member states are also members of the UI. And what we do at the Florence School of Banking and Finance is really to try to bridge the worlds of academia and industry and policy making. Specifically, of course, on the topics of finance and banking. So we do this in four main ways. We have executive education courses that anyone can sign up for. You find them on our website. Then we have cooperation projects. So these are capacity building projects, which usually include also an aspect of training together with other institutions. For example, we have big important projects with both the European Commission and the European Central Bank. We also do what we call policy dialogues, which are basically initiatives to bring together all these different sides and stakeholders in the industry, in conferences, seminars, workshops, and other such initiatives. And then, of course, we are within a university, so we do research and analysis, both with an academic focus, but a lot of also policy-oriented type of work. Here you can see some of our main partners. In short, if there is an institution that starts with an E for European, we probably have it as one of our partners, but also other institutions, including some private sector partners. So one of the things that we do is to host webinars and seminars on specific topics that we think are relevant for this industry and for policymakers. Today, we will talk about impact investing and specifically about the bridge or gap, if you will, between the objectives of the sustainable finance industry and the implications of the EU Sustainable Finance Disclosure Regulation. For your information, we will actually do more on the topic of impact investing. We have a full course coming up on this topic, 17th to 19th of November. You can find our information on the website. We will also put a link in the chat, so you can look at it. If I have a few minutes at the end of the webinar today, I will tell you more. Today, we are privileged to have here with us probably the best person to talk about this topic, in particular the SFDR, Dr. Nathan de Arriba-Sellier, who is the director of the Erasmus Platform for Sustainable Value Creation at the Rotterdam School of Management, Erasmus University. There, he promotes interdisciplinary research and collaboration with financial institutions on the transition and sustainable finance. Before that, he was at Yale, where he was research director of the Yale Initiative on Sustainable Finance. He's a legal scholar, but has a wide range of research interests, and his work has appeared both on academic publications, but also on prominent media outlets. Nathan was not happy with just one PhD, so he got a double PhD from Rotterdam and Leiden. Thank you, Nathan, for making me feel bad about my one PhD. So, Nathan, thank you very much for being here with us today. We really look forward to hearing what you have to say about this topic. The structure of the event will be fairly simple. Nathan now will proceed with a presentation on the topic. I will ask a couple of follow-up questions, and then we will open it up for Q&A. And if you have a few minutes at the end, maybe, as I said, I might be able to say a bit more about our impact investing course. Nathan, floor is yours.
Thank you very much, Lorenzo, for the kind introduction. I will start sharing my slides. Hopefully you can see it. Please let me know if you don't. Thank you very much to the FBF for this invitation. Very important topic, and at the same time, very heavy agenda to discuss impact versus compliance in SFDR. I'm not entirely sure of what is your familiarity of SFDR. Oh, sorry, what's happening now? Of what is your familiarity with SFDR. So I will perhaps recontextualize a little bit the debate on SFDR. And what the objectives of SFDR are before we go a little bit into the discussion between impact versus compliance, and concluding then on whether SFDR can help deliver sustainable finance, which is the core of this webinar. I also want to add here that this question of impact versus compliance in SFDR, there has been a lot of misunderstandings. So perhaps for you, what I will say is boilerplate, and you've already been told that many times. But for many, I assume that actually some of the things I'm going to discuss are maybe new or refresher, or things that have been forgotten into the mass confusion that SFDR's implementation has become. So the objectives of SFDR, from Paris to Brussels, because we have to go back to the Paris Agreement in 2015 to understand what is the philosophy behind SFDR before it became adopted and implemented in the Brussels arena. So to have a bit of more context, really the SFDR is just one of the products, one of the many products, I've only listed a few here, of EU Sustainable Finance Agenda, which was set by the high-level experts on sustainable finance in 2017, and then implemented by the Commission from 2018 onwards. And this comes from itself from the Paris Agreement, of course. Paris Agreement, one of the objectives of the Paris Agreement, besides climate change mitigation and adaptation, is to reorient financial flows, to steer investments to low carbon, climate resilient development. And so this is really the idea here, to bring sustainability into the mainstream of finance. That is the key idea at the core of the agenda, by steering financial flows to sustainable investments. This agenda exists in parallel to the EU Green Deal. Of course, the EU Green Deal provided further impetus, but actually it predates the EU Green Deal to a large extent. And there were many different outcomes of that. SFDR being one of them, I said it, taxonomy, the EU taxonomy, and the CSRD, which have become also intertwined with SFDR questions increasingly as they have developed. The two pillars of SFDR are, on the one hand, the integration of sustainability risks in investment, and on the other hand, the consideration of adverse sustainability impacts, or if you're a little bit more aware of the technical terms, the PAI, principal adverse impacts come from that. But when we talk about the objectives of SFDR, we have to remember that the main objective, what is SFDR about? It's about the D, Sustainable Finance Disclosure Regulation. The objective is to enhance transparency in the investment industry. And the idea is not new, actually, in financial regulation. It's that information in asymmetries penalize investors need to be addressed through regulation, through disclosure requirements, because with more disclosure, to simplify, the market will make better decisions and correct some of its market failures. So this necessity appeared in new light with climate change in the wake of the Paris Agreement, as we don't have historical data on climate change, given the inadequate nature of purely financial information as traditionally conceived. And so that's why we've had a push for more climate-related disclosure that led to the creation of a TCFD, the Task Force for Climate-Related Financial Disclosure in the wake of the Paris Agreement. Yesterday was the 10th anniversary of Mark Carney's Tragedy over Horizon speech, where this was a core idea. We need climate-specific information. And so SFDR is a little bit in this philosophy, based on this philosophy of providing specific sustainability information that we until now don't provide, and that's especially true for investment funds when the SFDR was adopted, because already corporates had some voluntary disclosure, but it was relatively rare for investment funds. So the three objectives of SFDR, to recap, are steering capital flows towards sustainable investments, mainstreaming sustainability into finance, and fostering transparency. And through that, the hope is long-termism. But the idea, unfortunately, was a bit perhaps premature, or was ill-conceived. SFDR sounds a little bit like putting the cart before the horses. The SFDR clearly innovates by integrating double materiality perspective at the core of reporting obligations for investment funds, but the SFDR preceded the taxonomy, which was adopted 1 year later, and the Sustainability Reporting Directive, the CSRD, which many of you may be familiar with, which came a couple of years later. And so we had, through SFDR, a lot of disclosure requirements that were introduced, while asset managers had to disclose on items that corporations wouldn't have to disclose. And so there was a clear imbalance here in the system that probably led to all this confusion and legal uncertainty that was detrimental to impact investment in particular, but the investment industry in general. So here, after this brief introduction, comes the question of really impact versus compliance, putting the SFDR system into question. And before I go really into the question of impact, perhaps to the deception of many, I will focus on the question of what is the overlooked baseline of SFDR, because most of the time this is absent from the discussion, and yet this is a huge achievement of SFDR. It is to put sustainability risk disclosure as a mandatory baseline. Until then, there was no requirement for investment funds to disclose about the risks, financial risks posed by climate change or other sustainability matters to the financial investments that they offered. And still today, neither in the United Kingdom with the sustainability disclosure requirements, SDR, or before the Trump administration, the SEC in the United States past proposal actually tried to replicate this sort of baseline on risk disclosure. And this baseline is also important because it entails some due diligence on the part of financial market participants in complying with SFDR. Also important to note is that SFDR, like most of EU sustainable finance law, does not merely focus on climate or environmental matters, but when it considers sustainability risks, it's sustainability risk at all. It may also be social risks. That is actually of interest to impact investors, as many also have social objectives that they try to pursue. Then the main risk disclosure obligations, and I will be quick on that, is just for financial market participants, so asset manager mostly, and financial advisors to disclose their policies on integrating sustainability risks. disclosing how remuneration policies are consistent with the integration of these sustainability risks, and how this sustainability risks affect investment decisions, investment advice are integrated in those, and what are the risks, the likely risks affecting the financial returns of financial products. So really a traditional perspective. But SFDR also innovated by being the very first piece of EU sustainable finance law to integrate double materiality. And that is where things become a little bit more interesting for impact investments. Because in the end, the SFDR provided a very flexible regulatory system built for accommodating different sorts of investors, from institutional investors to impact investors, different interests, different ambitions in financial investments. So there are different levels of ambitions that are envisioned by SFDR. And in general, if you look at SFDR, and this may come as a surprise to most of you, it affords a large margin of discretion to asset managers for the categorization of financial products. The regulation, to some extent, also operates to comply or explain principle. So do not, if you do not particularly envision sustainability matters into your investment decision, you can explain why you have not. Of course, this requires some level of disclosure, but it doesn't require you to provide the whole suite of disclosure. And of course, that's where it gets things tricky. SFDR distinguished between mainly two levels of financial products ambition, because I remind you that Article 6 SFDR on risk, sustainability risk disclosure, is a baseline applicable to all. So the two level of ambitions beyond risk is has been encapsulated by this dichotomy between Article 8 SFDR and Article 9 SFDR. Article 8 financial products are products that promote environmental or social characteristics, or a combination thereof. And this is very largely construed. It can be just some exclusion criteria. It can be more promotion of actual environmental investments. It can be through engagement policies, particularly active investments on environmental social characteristics, but not really on the selection of investments itself. So this is very broad, this is very large, and accommodates a lot of very different investment strategies or investment choice. Article 9 SFDR, on the other hand, is more demanding. It concerns financial products that have for objective sustainable investment. And sustainable investment is actually defined in SFDR, and perhaps some of you have heard of that, in Article 2, paragraph 17, which says that a sustainable investment is an investment that contributes to environmental objectives. It can be through water, land use, production of waste, greenhouse gas emissions, energy use, biodiversity impact, circular economy, or an investment in a social that contributes to a social objective, inequality, social cohesion, integration, human capital, socially disadvantaged communities. All of them, provided that this investment does no significant harm, this is the do no significant harm principle, to any of those objectives. What you may understand from that is that this is very broad, yet this is not very well defined and can lead to a lot of margin of interpretation. To some extent good for SFDR, because that accommodates partly different investment strategies, and for impact investors, there are rarely two impact investors alike. They may pick and choose and pursue different objectives. But if they want their investment funds, impact investment fund, to fit under Article 9 SFDR, the do no significant harm principle still sets some sort of baseline. And the question of how stringent this baseline is has been a huge question. For both, nonetheless, Article 8 and Article 9, companies that are investees must follow good governance practices. And those two have been relatively broadly defined, but still sound management, tax compliance is not a given for a lot of investees. And also transparency on that may be needed. And that's where the G of ESG is also interesting. While SFDR provides this flexible regulatory system, the burden of compliance has been evident for most. And it has distorted, it has negatively impacted SFDR, because while the regulatory burden mostly comes from disclosure requirement, the postulate of SFDR is that the more ambition you have, the more information you should provide to investors. And that requires, of course, a higher burden for a higher threshold for impact investors than for the general ETF that you have in the market. So the regulatory burden is higher for Article 9 and for Article 9, for Article 8 and for Article 9 investment funds. And what you may have heard of, if not you're really in this game, is that SFDR has been a source of regulatory confusion. It was very successful at first in promoting sustainability-oriented investments. And I remember in shortly after SFDR entered into force, many funds categorized as Article 8 or Article 9 funds. And it's great because self-categorization is a principle under SFDR, but it also led some to misread, including regulators. I'm not blaming asset managers or institutional investors only, but regulators also misread Article 8 and Article 9 as de facto regulatory levels. And so you had a lot of so it became common practice now to talk about Article 8 funds and Article 9 funds. Well, this is not exactly what the philosophy of SFDR is about. It's about disclosure. And so you had a lot of marketing communication about, look at my fund, it's Article 9 funds, it's particularly ambitious. So it really is good for investors that have this level of ambition. And regulators, of course, sought to crack down on greenwashing practices because it led to point where there were little distinction between a classic Article 6 fund, so to say, and a more ambitious one that could have been categorized as Article 9 or Article 8. And there were also a lot of questions, partly on part of nonprofits, about investments in fossil fuels that were still very important in Article 9 funds, even the most ambitious. So there were a lot of a pushback, including from regulators, on these greenwashing practices that disincentivized the categorization of financial products under Article 9 and had a chilling effect for more ambitious sustainability funds. Maybe some of you know that, for instance, the European Commission, in a Q&A, so it was not even a regulation, a requirement, but in a Q&A, said that 100% of investments under Article 9 should respect strictly the definition of sustainable investments under Article 2, paragraph 17, which was not the spirit of SFDR. Even if you read the letter of SFDR, it says Article 9 is about the objective of sustainable investment, not sustainable investment as a given. And again, in Article 2, paragraph 17, you talk about the objective, environmental objectives or social impact objectives. This does not need to have been achieved. But yeah, anyway, they had a chilling effect on a lot of sustainable investments. It could have been avoided, and more attention should have been paid on the supervision of marketing rather than trying to discipline these as labels. But here we go. And so we have now Article 8 funds as a lot of a bit of everything, with funds that have no clear or explicit considerations of environmental or social objectives or characteristics. That's top right on this graph from MSCI that was issued in after research that was issued in 2025 this year. But then you also have a lot of funds that have been exclusion-based, and then much more ambitious funds on the bottom left part of the criteria. So To conclude, perhaps before we get a little bit more technical in the Q&A, can SFDR help deliver sustainable finance? It's a bit of an open question. It's a bit of a yes and no. SFDR clearly made sustainable finance more mainstream and more transparent. A majority of assets under management are invested in financial products under Article 8 SFDR. That's approximately 55%. Some 5%, that's very little of assets under management, are under Article 9. And you have a lot more disclosure through the principal adverse effects, principal adverse impact statements and disclosure on a range of disclosure requirements that do not really match CSRD. You also have a lot of taxonomy disclosure in Article 8 and 9 SFDR funds. So there has been more mainstream, more transparent investments. But the practical challenge, especially for impact investments, is that SFDR was not built with view to promote impact investments. And while ambitious financial products provide more transparency than the market at large, it means that the reporting compliance burden is partly high for these funds, deterring compliance with Article 9 funds. And I've heard that partly in the Netherlands, where I'm based, that a lot of institutional investors wanted to have the funds categorized as Article 9 funds, but the supervision and uncertainty made it had a chilling effect. And on top of that, you have now guidance from the European Securities and Markets Authority, ESMA, on impact name funds, which is relatively restrictive. So after a transitional phase, there is currently much more legal certainty now as to what is required, and we have an upcoming reform to simplify regulatory requirements. So hopefully compliance could become easier, and we'll go back slowly but surely to a more accommodating environment for impact investments, which certainly SFDR should have provided for, but did not in the end because of regulatory interpretation part. Thank you very much, and looking forward to the discussion in the Q&A and digging in some of this matters, getting a bit more technical. Thank you.
Perfect. Thank you very much, Nathan. I have a couple of questions, and in the meantime, for all the participants, please continue to add questions to through the Q&A function. I can see that there are already a couple popping up. So the first one is maybe not technical, but I think I want to go to the core maybe of this compliance versus impact with this question. So if I am a fund manager and I want to demonstrate real world impact, and in this way also maybe distinguish myself from competitors, at the end of the day, does SFDR help me? Or because it has created these more standardized categories, in some ways it facilitates greenwashing, let's say greenwashing, to stay sort of in the green space, but of course there are other types of impact. So does it help me, or does it help others look more like me?
Well, it's really two questions here, because SFDR does, I think, help you as an impact investor, because it provides you with an environment that helps you distinguish yourself from others. And I strongly believe that Article 9 was built to accommodate impact investors, impact investments with this sustainable finance objectives. That sustainable investment objective is at the core of the philosophy of impact investment. And it also helps you because as it is a disclosure regulation, it also provides more transparency, and you can make yourself particularly distinct from others by providing the disclosure that is appropriate. And if you are an impact investor and you have impact investments, then the information you will provide will look much better than a general ETF or another type of fund that is Article 6, Article 8. Yet it has led to a lot of greenwashing, and that has been the paradoxical byproduct of SFDR, because It did not try to discipline names. It did not create labels. It had been widely interpreted as creating labels. And so even in absence of this Article 8, Article 9 distinction, a lot of funds could say, I'm an impact fund or I'm a transition fund, and name yourself like this before ESMA came in with its rule. And so, of course, now the crackdown has been partly strict, partly hard. And so it has also deterred impact investors because of a risk of non-compliance. And when you impact investment funds, you're not partly big, so you also have higher compliance reporting costs compared to a much bigger ETF. So this is not probably very helpful. So it's a bit of both, unfortunately. But I do believe that SFDR is here to help.
Okay, and so you mentioned that there might be a new version, so changes to SFDR coming up, and you mentioned that within that there might be potentially something more dedicated to impact investing. There might be an impact investing category. I heard. Can you tell us more about that? And can you tell us more about whether you think it's a good idea or it risks again being sort of an over specification of something, but without material effect?
Yes. Well, I'm going to say right now what we have is rules, so guidance provided by ESMA, the European Securities and Markets Authority, that says, okay, if you're an impact fund or a transition fund, then there are certain exclusion criteria that are required of you. And those exclusion criteria relate notably to fossil fuels, but also other sort of like classic exclusion criteria in terms of involvement in controversial weapons or and there's also the DNSH, of course, that is that. And there is this requirement, according to the impact, to the name guidance of SFDR, that is, if you have an impact name, then the idea is that 80% at least of your investments should be in impact investments. And so that actually is good because it deters greenwashing. Then of course, it's a guidance. There are a lot of moving pieces, and it's relatively recent. It is not here to accommodate all sorts of impact investments, especially like if you want to really help the transition, for instance, the energy transition. And so that is a little bit. It is not perfect. It is not set in law. It is more supervisory guidelines, and also from a country to another, supervisors may more or less well enforce that because we're still in a system of supervisory fragmentation. Then there is a question of what is the place of impact in the future of SFDR, because the European Commission, is looking at revising SFDR with a view to simplification in line with previous omnibuses proposals that have been made. And so there is this, and I think I saw that also in the Q&A, there is this idea that we should reframe the categories of SFDR with basically this distinction between sustainable, transition, and non-categorized. And there have been a lot of, especially in the impact industry, that have asked for the integration of a new category specific to impact. What is my opinion on that? To be honest, I do think that today's system is already largely accommodating of impact investment. It could be simplified. There could be perhaps a better distinction between within the Article 8 categories, which is a melting pot of everything and anything. So there might be some clarification needed, but I do think that if we were to keep this Article 9 category, it was still there to accommodate impact investments. Could be simplified, should be simplified, but simplification, of course, always comes, especially in Brussels regulation, with a risk of increasing greenwashing risks. So that's always the tightrope on which to walk.
Super, thank you. I think with this we have answered Enrica Bruna's question on the dedicated impact category, but of course, Enrica, follow up with another question if we haven't covered everything that you wanted to hear on this. We also have a question from Pallavi Rajan on the Article 8 plus funds. So could you also speak of Article 8 plus funds, that is Article 8 funds, which include a proportion of investments meeting a sustainable investment objective, similar to Article 9 funds?
Yeah, and that's a little bit to what I was alluding to right now. There is no specific category of Article 8 plus funds. There is now this name rule from ESMA that provides some clarification on naming of investment funds, but in the end, they're subjected to the same regulatory requirements under SFDR. And Article 8 funds, as I was showing, I think in the graph before of MSCI, they are very ambitious funds that suffered from the chilling effect of the regulatory uncertainty and confusion that prevailed in the first years of implementation, and so have been downgraded basically to Article 8 to provide for some certainty. And then you have the more, and you also seen that there are some, within this Article 8 categories, there are also some funds that do not make clear what environmental social characteristics they actually promote. So this Article 8 funds, 8 plus, to take over this formulation, they can still make a distinction because the level of disclosure can be enhanced. For instance, on engagement strategies, I would imagine that a lot of Article 8 funds that mostly replicate the market as it is, follow passive investment rules, will not provide much information on that, but more ambitious Article 8 funds can provide information on their engagement strategies. They can provide more information about the level of specificity of the environmental objectives that they do pursue, whether it's as 80% plus of their investments or a lower category of that. And so they can provide some disclosure. It is of course comes with perhaps a higher compliance burden, but it is possible. And of course, I hope, like, the question was a bit broad, so if I did not answer it fully, please get back to me.
Great. We have a follow-up question from the same person. Given that many disclosures remain voluntary, what is the broadest set of fund level data or disclosure that has actually become available as a result of SFDR? For instance, while one might expect mandatory PAIs to be widely available, in practice, they're often selectively disclosed, with reporting required only at the aggregate asset manager level rather than at the fund level. And I'll attach a comment/other question to this, which is, we talk a lot about the implications for fund managers. What are the sort of downstream implications also for investees, therefore?
Yes, there is indeed, and that's perhaps there's also here a question of entity level versus product level disclosure. And in both cases, while like the Commission delegated regulations have provided a set of indicators to provide, there is still largely the possibility for asset managers to cherry pick on the disclosure items, on the PIs they want to disclose against, and that has created some problems. There is the question, I think, is there are PIs that are widely available, and so, for instance, on greenhouse gas emissions, there is, I think, the broad expectations that those has to be provided. But indeed, otherwise, depending on the characteristic of the fund and also what the fund wants to do, they can provide different different disclosures. And just to recall what I said previously, the problem also comes from the fact that this disclosure, the data provided by the fund manager, whether it's at the fund level or it's the entity level, comes from a collection of information from investees or from data providers, which itself is not very reliable, may not exactly match the objective of a fund itself. And so that creates even more difficulties for fund managers. Now we have CSRD, and CSRD will hopefully provide some level playing fields for funds managers. Although the simplification, de-scoping regulation omnibus that the Commission is proposing will probably undermine that. But also today, what we have is still a lot of estimated disclosure, estimated data that is not subject to stringent assurance requirement or even limited assurance requirement. And so that makes things particularly difficult for actually having sufficient high quality transparency by whether at the fund level or at the entity level for asset managers. So yeah, that's the difficulty here. And that's partly the difficulty for impact investors, I may add. Sorry, I'm gonna just dig in a couple of minutes for impact investors, because impact investors do not generally invest in S&P 500 or huge companies that have the means to provide very specific information. Also, impact investors may have objectives but do not partly match with the PI's indicators that the Commission provides for. And so that's also the challenge comes from there.
Yeah, and I think that's what might lead to some sort of selection bias against Article 9, even for funds that sort of a priori would be absolutely aligned with the purpose of the Article 9, could be sort of the fear that the implications for the investee companies, if we are talking about small companies that don't have the resources and compliance apparatus of an S&P 500 company. I think that's possibly one of the dynamics that is at play, and why some funds that could, maybe themselves be Article 9, when they think about their investees, they might decide that maybe it's better to take the Article 8 route. We have a few more questions. One is related to digital assets. So does SFDR apply to digital assets pursuant to MiCA regulation? I think there is a second part of the question, which is Article 8 in particular, when designing asset reference tokens with a sustainability component.
Very good question. And to be honest, the short answer would be I'm not sure. The slightly long answer is that SFDR does apply to digital assets as long as they are included in financial products that are marketed. So if you have an investment fund that you provide and that have investments in digital assets in part or in whole, then SFDR would apply to that. And it would apply partly to the risks, I would imagine. The risks of this sustainability risks entailed by those digital assets, whether it's asset reference tokens like stable coins or others, or crypto assets more broadly construed. So that is the answer. Of course, there are difficulties also here determining, I guess, for asset managers to understand what PIs they can report against these crypto assets. There may be indeed asset reference tokens that have a sustainability component. I can imagine that, for instance, commodities, if you are asset reference tokens that are based on a basket of commodities, among others, could have one. But then it would have to be like the disclosure needs to be clear here, and this may be difficult to access also because of the inherent nature of digital assets, and so that is a bit of an open question, but in general it does apply to digital assets as long as they are captured by the scope of SFDR, which is really financial products that are available to retail investors or more professional investors.
Perfect. Thank you. I also, this is obviously a very specific question, although super interesting. So I encourage Victor Schumack, who asked it, to reach out to you if he wants to continue.
And if someone has an answer to that, please put also
yes,
in there.
please do put it in the Q&A. But super interesting. We have a question from Diara, which I think goes a bit to the core of the discussion. She says, or he, can we really achieve positive real-world impact results if funds are given no normative benchmarks of what this impact is? So can we say that without such an impact, the rest is just additional financial products colored green without bringing any change to the world?
Very good question. I think the answer is a little bit in the question. And I think there is positive real-world outcome that SFDR can provide, because there is like this category of Article 9 was for. Once again, it's really sustainable investment as an objective. And recent like interpretations of this Article 9 categories have been partly strict and have partly emphasized the DNSH component for do no significant harm, that while the investment should pursue a specific objective, environmental objectives, social objective, or a combination of both, it should not harm any other environmental or social objectives. And so here there is, I think, a huge potential for indeed achieving through financial investments positive real-world impact. Then, if it, indeed on the level of disclosure, the disclosure may not, the PIs, indicators that we have are not very good normative benchmarks for impact, because what they focus on also is negative impact. They focus on preventing principal adverse impact. And so, well, you can say, and for a lot of impact investors already, reversing negative impact is already good, but would not provide really indicators for achieving a positive impact. And that's where perhaps also the combination with CSRD is perhaps a little bit more interesting, because CSRD can provide a little bit more information. The problem is that CSRD is still restricted to companies that have more than 250 employees. Recent amendments of the Commission of the Parliament Council would put that threshold much higher, so that will capture many less companies, not SMEs, where we could achieve, through which we could achieve most positive real-world impact. So that is what is also a difficulty for this impact investors. And I think there's always a question of how do you measure this change, even for impact investors? How do you measure this change? How do you report against this change? And how also you can enable companies to report in a sound way changes according to the objectives that you pursue, which may not be partly the objectives of a company. Companies may contribute to those objectives, but may not pursue them. So there's always like distinctions that may make things difficult. But yeah, great question.
Yes, and I think what you were saying just now, and this question goes a bit to the core of what we will look at with the impact investing course, which I'll talk about in a minute, but we have a few more questions. So what role this is from an anonymous attendee, so I don't know their name. What role will SFDR feature specifications play when the ESG regulation comes out?
It's a good question, and I guess what the attendee here talks about is the ESG ratings regulation. It has been adopted by European Parliament and the Council, and will soon enter into force. And that is interesting piece of regulation, because it just, like, while we have had a lot of ESG ratings against which companies were rated, that provided broad disclosure, but not partly adapted to, let's say, impact double materiality standards. This ESG regulation will also provide more transparency, will force ESG rating agencies to be more upfront with what they include, what is their methodology, what are the benchmarks, to which extent they consider double materiality. So SFDR can be supported by ESG rating regulation coming in, but still also because this informs some indexes, benchmarks, that on which some SFDR Article 8 investments could, for instance, rely. But I don't think the rule will be instrumental in terms of impact investment, because there are also so many distinctions between these ESG ratings. And when you impact investor and you want to measure one specific objective, the answer may not be given through ESG ratings. It may be coming rather closer to the source, the primary issuer of the company itself. Then if the attendee is speaking about ESG regulation more broadly, as in the different strands of regulatory proposals that are currently being introduced, or even the SFDR revision, then I think there is a lot more SFDR could do. Here, I'm thinking, for instance, if we have an impact investment category, or if we have the Commission use this opportunity to refine enforcement engagement practices, provide a little bit more certainty, and most importantly, coordinate SFDR with the CSRD, with the taxonomy, with the omnibus, because as I was telling you, at some point, we had a bit of a reverse engineering construction where SFDR came first, then taxonomy and the CSRD, and now we have the opportunity to rethink it in a more comprehensive manner, and make sure that all parts are coordinated and are coherent with each other.
Yes, coordination certainly very welcome. We have perhaps the last question from Enrica Bruna. So based on the experiences 2021 and the upcoming SFDR revision, do you think that the key to tackling greenwashing lies in more ambitious minimum requirements and clearer definitions, or rather in stronger supervision, given the challenges that are there with data availability and things that are hard to change?
Yeah, excellent question. This may have transpired from my presentation and my answers already, but I'm a strong believer in stronger supervision. I think the pitfall of standardization, further standardization, is that you don't accommodate very well different situations, different objectives, especially sustainable fund objectives, impact investors objectives. While through supervision, you can do that. And already we should have had that. We shouldn't need even SFDR revision, because today the law already says that disclosure should be fair, non-misleading, and there is Article 13 of SFDR that says marketing should be commensurate to the objectives of fund disclosure. And so supervisory authorities should have used that in supervision in order to provide tailored adjustments and guidance, rather than trying to provide one-size-fits-all answers that's only created a chilling effect into impact investment. And so yeah, I really agree that stronger supervision is the key here. The upcoming SFDR revision is unlikely to go this way. But if there are any people from the European Commission out there, or people who have a say in those, I would really encourage you to think about the revision of SFDR as a chance to reunite, reconcile, get back to the original ambition of SFDR as a sustainable investment law. And so, of course, regulate greenwashing, but also think about whether we shouldn't have harmonized fiduciary duties across Europe to allow for more sustainable investments, accommodate better impact investors, and if you simplify, don't deregulate, simplify in order to provide more legal certainty. Because the problem is that impact investors and the investment industry at large has been through changes in regulation and enforcement and guidance multiple times over the past years, and we don't need more of that. We need a little more stability in order for the industry to consolidate and to go forward.
Perfect. We had one last comment, but it was more of a comment. So I added it to the chat. It's a useful link to a paper. I'll use, well, Nathan, first of all, I want to thank you again on our behalf, but also on behalf of all the participants. I thought this was a super on point. Clearly got a lot of feedback and questions, which made the discussion even more interesting. We have a couple of minutes, so I will conclude with some more information about the very related topic of which is our impact investing course coming up. I hope this can be interesting for several of the people in the digital room. So yeah, for those who are interested in learning more about this topic, and especially I would say what Nathan was talking about, and some of the questions as well, about like true impact and maybe other ways, other impact objectives, and how do you measure that? How do you do that in practice, sort of aside from what the regulation requires? That's basically what we're going to teach in our 3-day course, 17th to 19th of November in Florence. So this is a residential course, so great opportunity to come to Florence if you haven't been yet. And even if you have been, but you haven't been to the European University Institute, which is a wonderful place, Nathan is nodding, so he has been, definitely a good opportunity to do so. So the idea of the course, as the title suggests, is really to provide a very practical, hands-on guide to navigate the space, so the impact investing space. We are very excited about it. I would say we really have a top faculty from across the private sector and public sector, so institutions that do this, as well as also profiles from more of an academic background. And I would say, in short, is really going to be a great way to hear how to do this, how to do impact investing from the people who do it best, who have been doing it for a long time. And we really hope to see some of you who attended today, and maybe other people in your network who you think might be interested in this here in Florence in person for this. In any case, I hope you find it helpful. I certainly hope you found today helpful. I did, Nathan. It was great hearing from you. And so, unless there are any other last-minute questions or comments, I'll thank you all for joining, and wish you a great rest of the day.